So you just sold a property, right? You're looking at that huge profit and it feels amazing. But then you see the tax bill. Suddenly that win feels, well, a lot smaller. But what if I told you that you didn't have to pay that giant bill all at once? What if you could actually spread it out over time, paying taxes only as you get paid? Well, there's a totally legit IRS-approved way to do just that, and that's exactly what we're going to break down today. I mean, just imagine it. You finally sell that investment property, maybe the family business you poured your heart into. It's a huge success, a real milestone. But then you sit down to do the math and, whoa, the capital gains tax is just staggering. It feels like this massive chunk of your hard-earned profit is about to vanish in one single payment.
Yeah, a bill like this, 150 grand, due, like right now, that can totally wreck your financial plans for the whole year. And you know what? It's a super common shock for sellers. But it absolutely does not have to be your story. There is a much better way.
So what is this better way? It's the idea that you can pay that massive tax bill in smaller pieces over several years as the cash from the sale actually comes in. And guess what? You can. This isn't some shady loophole. It's a strategy built right into the tax code, specifically designed for this exact situation. All right, so here's our game plan. First, we'll look at the main tool for deferral. Then we'll get into the nitty-gritty of calculating your gain. After that, we've got to talk about some of the gotchas, the interest you don't see, and some special tax rules you really need to be aware of. And finally, we'll pull it all together with the key takeaways. Okay, let's dive into our first section, the tool for deferral. The strategy we're talking about is officially called the installment sale method. This is the engine that makes the whole tax deferral thing possible. So, what exactly is an installment sale? Well, the IRS definition is actually pretty simple. If you sell a piece of property and get at least one payment after the tax year of the sale, congrats, you've made an installment sale. But here's the really wild part. This isn't some special thing you have to apply for. It's the default. The IRS automatically assumes you're using this method unless you take the time to formally elect out of it on your tax return. Now, of course, this doesn't work for everything. There are a few big exceptions. First, you can't use it if you sold at a loss. I mean, it makes sense, right? The IRS isn't going to let you spread out a tax deduction. It also doesn't apply to the sale of inventory or for stuff like stocks and securities that are traded on a public market. Okay, so how does this actually play out on your tax return? Well, it all comes down to one specific form, Form 6252. And that entire form is designed to answer one single crucial question. For every dollar you receive from the buyer, how much of it is actually taxable profit? And it's really just a three-step process. Super straightforward. Step 1, you figure out your total gross profit from the sale. Step 2, you determine the total contract price. And step 3, you use those first two numbers to calculate something called the gross profit percentage. And trust me, this percentage is the magic number that you're going to use for the entire life of the deal. And here is that core formula. It's simply your gross profit divided by the contract price. So what's gross profit? Think of it as your selling price minus your adjusted basis, which is just a fancy way of saying what you originally paid for the property plus any improvements you made. You take that profit number, divide it by the total sale price, and boom, you get your gross profit percentage. So let's make this real. Imagine you run the numbers, and your gross profit percentage works out to be 60%. That's it. That is the critical number. It is now locked in for the entire life of that agreement. No matter what, every single time you get a payment from that buyer, you're going to use that 60% figure. So what does that actually mean? It means if the buyer sends you a payment of, say, $10,000, and this is for the principal part of the loan, not the interest, you don't pay tax on the full 10 grand. No way. You only report 60% of it, so $6,000 as your taxable gain for the year. The other $4,000? That's just considered a tax-free return of your original investment. Pretty cool, right? Well, this is where things can get a little complicated. All right, now it's time for our first big gotcha. This is a classic one. You might be thinking, hey, to keep things simple, what if I just make a deal with the buyer for a zero-interest loan? Nice try. But the IRS is way, way ahead of you on that. What you'd run into is something called imputed interest. Basically, under Section 483 of the tax code, if your contract doesn't charge a fair interest rate, and fair is usually based on something called the applicable federal rate, the IRS will just pretend that it does. They will literally take a portion of what you call principal and relabel it as interest for tax purposes. And why do they do this?
The reason is actually pretty simple. Interest income gets taxed at your regular higher ordinary income tax rates, but capital gains get those special lower tax rates. So this rule is all about preventing people from cleverly disguising what is really interest income as part of the sales price just to get a lower tax bill. The bottom line is you have to charge a reasonable amount of interest, or the IRS will do it for you.
Okay, on to the next section. We've got two more really critical rules that can trip people up if they're not careful. We're talking about depreciation recapture and what happens when you sell to a related party. And believe me, these aren't some weird, obscure situations. They pop up all the time in real estate deals. So when you sell a rental or business property, your profit usually isn't just one lump sum. It's often split into two different tax buckets. In one bucket, you have your standard capital gain, which gets taxed at those familiar 15 or 20% rates. But in the other bucket, you have the part of your gain that came from all those depreciation deductions you claimed over the years. The IRS calls this unrecaptured Section 1250 gain, and the key thing to know is that it gets taxed at a higher rate, up to 25%. And here is the real kicker. And this comes straight from the Treasury regulations. The IRS makes you pay back that higher taxed 25% gain first. Think of it as a front-loading rule. What this means is that in the first few years of your installment payments, every single dollar of gain you report is going to be taxed at that higher 25% rate. You have to completely pay back all that depreciation recapture before you can start recognizing gain at the lower 15 or 20% rates. Okay, that second special rule is all about selling to what the IRS calls a related party. And you got to be careful here because it's not just your spouse or your kids. We're also talking about your parents, siblings, grandkids, and even a corporation or a partnership that you control. The IRS pays super close attention to these kinds of deals. And here's exactly why they're watching. There's a really important 2-year resale rule. Let's say you sell a property to your brother on an installment plan. If he turns around and sells that same property for a big pile of cash within 2 years, your entire tax deferral plan gets blown up. The IRS will force you to recognize all the rest of your original gain immediately, in the year he makes that second sale. Your deferral is just gone. Whew, okay, that was a lot of technical detail, I know. So let's boil it all down and look at the key takeaways you absolutely need to remember. All right, let's run through a quick checklist. First, the big benefit. You get to defer your tax by spreading the gain out over multiple years. How do you do it? The main mechanism is Form 6252 and calculating that all-important gross profit percentage. But then you've got the gotchas to watch out for. Gotcha number 1, imputed interest. You have to report it as ordinary income. Gotcha number 2, that 25% depreciation recapture gain, you have to recognize all of that first. And gotcha number 3, the 2-year resale rule. Be super careful with that when you're selling to a related party. Look, when you structure it the right way, an installment sale can take a terrifying, immediate tax bill and transform it into a totally manageable long-term plan. It's all about aligning your tax payments with your actual cash flow, and it can be an absolutely brilliant financial move. So the real question is, could it be the right move for you?